for those who are watching this, whether you're an investor or an agent investor, keep your eyes open for opportunities because they're out there, but you're not going to see them if you're retreating in fear and just scared, or if you're just focused on survival. I will tell you that the market for investors, like competition for deals, has gotten increasingly more difficult since 2008. When I started, I started with nothing, right? I literally used a credit card to buy my first property. I was broke, living in an apartment. But I've done 500 plus deals ranging hundreds of single family, commercial, land, mobile home parks, RV parks, all that kind of stuff. And we have a perfect track record of always performing with our lenders, our loans, my credit, all that kind of stuff has been perfect.
What's going on, guys? We have an incredible podcast here today with one of the most successful real estate investors and agents I know in the game today. We're going to ask him a lot of questions about the state of the market. He doesn't even know the questions I'm going to ask him. I'm not even sure I know which questions I'm going to ask him. It's going to kind of play out because this is an important conversation, guys, to figure out what's going on in the marketplace with someone who's doing it live time right now that does both sides of the business. Here's kind of his running record here, guys. So Brant is a developer. He's built properties. He's a house flipper. He's flipped hundreds of houses. He's done everything in single-family residential real estate up until now, where he's now doing bigger deals in commercial. He's taken down mobile home parks, big land deals, breaking these properties down. He's also a licensed real estate agent here at eXp. He's one of the top leaders in the Wolfpack organization, has almost 400 agents in his real estate team. He's also a multi-time icon agent, an author, and on social media. And I could go on, but I know you want to hear from him. So let's get him on the show. But we're going to ask Brant some questions today about the state of the market, as there is a lot of fear out there. A lot of people are worried as far as their investment business, their agent sales business, every industry. And I think it'd be interesting just to get the take from someone who's actually active, who's been doing this for 20 years, and kind of get into his mind a little bit on what's going on in his business and what he thinks is going to happen coming forward over the next year or two. And I'm going to stop talking and let you get on here, Brant. But thank you for your time. I know it's not free, and I know you're busy. But first off, what is your take on what's happening in the marketplace right now? Are you seeing anything impact your business? And we'll just kind of start there.
Yeah. No, appreciate that, Connor. So officially finished 16 years in the business. And so when I started was 2007, and the shakeup was about to happen. You could see the writing on the wall, and then 2008 came, the blood on the streets. So today's market is different. The landscape is different, but there's opportunities all around us. And that's, I'd love to spend time talking about that a little bit today, is that I see so many other investors and agents who they're reacting in fear rather than excitement and looking for opportunities. It's happening. We know the psychology of, like, if people are just watching the news or looking at, clickbait or whatever it is on their phone about all this negativity, it just encompasses all of their thoughts, and they react out of that fear. So I'm seeing it, and I'm seeing opportunity, right? So there's opportunity all over the place. We're seeing it on our single family side of things. We typically buy 3 to 5 houses every single month. I'll give you a case in point. We bought a house about 6 months ago that was a really good deal for $130,000. Yesterday, my acquisitions agent hasn't locked it up yet, but he's negotiating a carbon copy deal right down the street. Same square footage, same neighborhood, all that kind of stuff for $95,000, right? So $40,000 less than a deal that was already a really good deal. A house we've already bought, fixed up, and flipped for like a $25K profit, and this one's $40,000 less. So I think that kind of shows you, case in point, what is going on in the marketplace. And I've heard this oftentimes. I've seen it to be true, right? Is typically the marketplace is like 6 to 9 months behind meaning you're at your average Joe or whatever in the marketplace. They're 6 to 9 months behind of reacting of what's really happened in the marketplace, right? So us as investors are really knowing what's going on with interest rates and all this kind of stuff. And so we're thinking forward of, like, hey, we've got to plan out for the next 6 months and start safeguarding right now. That doesn't always translate in your offers to motivated sellers. They're about 6 to 9 months behind, and they're like, okay, we get it. We got it. Things are bad. They've got to make decisions. And that will happen also when we come out of this market, is some of them are not understanding we're coming out of it. And so it's a really good thing because you can buy houses at a substantial discount, even though the market's turned and the market has shifted. So we're seeing things like that. We are under contract, for example, to buy it's a mobile home RV park and storage facility. And, he's like, man, I'm ready to get out. I'm ready to be done. He's made several mention about all the stuff, going on in the world. And people just want to be out. And so for those who are watching this, whether you're, an investor or an agent investor, keep your eyes open for opportunities because they're out there, but you're not going to see them if you're like, retreating in fear and, just scared, or if you're just focused on survival. I've intentionally shut some things down that I was doing over the last year or two because I've been waiting 14 years for another 2008 to come. And this is a different market, obviously, because back then you could walk down the street and trip over real estate deals, but you couldn't find money. And that was a big difference of today. Today the deals are really hard because our inventory is so low. Money's readily available, right? And so what we're kind of getting ready for is we know we've got low inventory. We know houses are, not plentiful like they were. So we're going to grab as much real estate as we can while other investors are sticking to their 9 to 5 or doing whatever they're doing, and just kind of, seize the opportunity while it's here, because it won't be here for long.
So we're moving into September here. Just guys, give you an idea, if you're coming across this podcast later in 2023, what do you think is going to happen as far as like prices? Do you think we're going to see a correction where we're going to continue to go downward? Or I've heard some people actually think property values are going to continue to go up based off of things like hedge funds overpaying for things is artificially driving it up. Just kind of what's your take on, when did this tough market in your mind start? Backtracking it 6 months, 12, 18 months ago, do you think we're on the downside and going to bottom out? Or do you think where do you kind of think we are in this type of cycle?
Well, I will tell you that the market for investors, like competition for deals, has gotten increasingly more difficult since 2008. All right. Whenever it bottomed in 2008, every single year it's gone up another level, meaning there have been more investors come into the marketplace with very few exiting the marketplace. There's been more money come into the marketplace, et cetera, et cetera. So that has continually got increasingly more difficult since 2008. And so I know that this is the first year I'm like, okay, I think this year is now, it's feeling easier than last year. We've bought more property this year than we did at this point in time last year. So I think that we're starting to see the uncertainty, and really that's what it is, Connor. It's not about opportunity. It's not that real estate is not going to, be great moving forward. It's just uncertainty and fear.
Yep.
So there's less competition in the marketplace, and that's good. The really difficult thing right now is just the inventory. So I don't see, like, we're in Texas, and I don't see a likely scenario where real estate prices are going to drop. I know there's always, like, there's the black swan event or whatever, that there's something that could happen that we don't see coming. Obviously that could happen. But in terms of, inventory, I don't even care about interest rates. I'm just about, like, our inventory, the way our population is growing, all this kind of stuff. I don't see how that's going to happen,
Yep.
So we are buying like we always have. The only thing I would say is I think it's really important, like incredibly important, for those who are investing, whether new, moderate, expert, or whatever, is make sure that you're investing with a sustainable business model. And that's also, oh man, so that's also, because there is risk in investing. So I'm not telling anyone, like, don't have fear. Like, there's healthy fear and there's non-healthy fear, like useful fear and non-useful fear. So one of the things, like, since I've started 2007, is going, fast forward to today, we've done right around 500 deals. And I don't like to toot my own horn, but I heard Grant Cardone the other day say, well, if you got a horn, if you got a horn, why don't you toot it? So, so to toot my own horn a little bit, and it's really going to go into what I'd like to talk about is after doing 500 deals, we have a perfect track record on our performance with our lenders. It doesn't mean I haven't lost money on deals, lost a lot of money on deals, but when I started, I started with nothing, right? I literally used a credit card to buy my first property. I was broke, living in an apartment. But I've done 500 plus deals ranging hundreds of single family, commercial, land, mobile home parks, RV parks, all that kind of stuff. And we have a perfect track record of always performing with our lenders, our loans, my credit, all that kind of stuff has been perfect. So the more important question is like, how can investors take advantage of the marketplace successfully and sustainably, right? By avoiding risk at the same time. That's really, to me, is the question, because I want a sustainable business. I've kept a perfect track record with my lenders. I intend to do that till the day I die. So it really is factored on sustainability. So when you hear me talking about opportunity and what I see in the marketplace, I think it's really important to know what we focus on with our businesses is affordable housing. And so what I like to tell people is we like to buy properties at median price housing and below. That's a very quote unquote safe spot for us, because when we're buying at median, price housing, which is somewhere, in the low 300s in Houston. So we're buying below that, right? So if we're buying a house that's worth 300,000, we're probably buying it for 150,000, putting 50, 60 in repairs. And then we have options in, because if we're buying a property that has, $50,000 to $80,000 of equity and it's worth 300,000, then let's say that the market absolutely tanks. Let's say interest rates go up to 12%. It tanks, it flattens, whatever. We still have options there, because we could potentially flip it and just not make much money or break even, whatever, move on to the next one. We can rent it out. We could Airbnb. We could owner finance, which we do a ton of, and we have options. If you're playing north of that median price point line, right? So if you're in, $500,000, $600,000, $800,000 marketplace, which I've been there and I've done that, and the market shifted and turned on me. And when oil and gas was drying up here in Houston, it was really painful. I took some lumps. Always paid my lenders, but took some big L's on deals. It just wasn't fun. So I would strongly encourage you guys, whether you're looking at commercial, multifamily, single family, is make sure you're looking at it through a lens of sustainability, and that you give yourself different exit strategies, because you don't want to be that investor who has one exit strategy and that exit strategy is not fun.
Maybe let's talk about private money here a little bit, because you're one of the first people that had the same thoughts that I did, because we didn't talk about this before the podcast. I actually been telling people I thought that the market still could keep going up in price, and I think I get a lot of blank stares. And then also, that there's still deals out there to be found. And, you mentioned it's been getting harder and harder since 2007, 2008 to get deals. I think a lot about, not market share, but as far as inventory out there, but market share as far as how many investors are in the market. Think about from like 2010 till now, how many education companies popped up, how many big gurus popped up, how much extra trending on social media popped up. So you create this mass influx of new investors, but they're fly by night, most of them. I mean, very few are going to take the business serious. So it's not the main solidified companies in your area doing thousands of deals a year. It's the thousands of investors doing one or two a year that really eat up the inventory. Now, here's just kind of my opinion on what I think we're going to see, because I'm starting to see this in my local market. I think we're going to start seeing more deals come on the market, even though prices can go up, because I think investors are the ones that have active working money in the industry right now are going to go away a little bit, because what we're seeing is people are struggling with their business, so they have less money to get into hard money loans, so they can't get into that front side position. And then a lot of them are sitting where they have 2 or 3 houses right now where they're over leveraged. They can't go to get a back in second position loan, and they're kind of sitting there and they can't finish the houses out. Now, as this happens, slowly that market share is going to shrink as more investors get pinched out the bottom side. leaving those that have money for marketing, leaving those that have money to close deals to kind of step into that market share position. What do you think on all that? Like, as far as moving forward the coming months, do you see that happening with a lot of people getting to where they can't get into the front side of these hard money loans?
Yeah, for sure. For sure. And I think that, one of the things I say with investors, I got asked this question this week, is, hey, as a new investor and they're looking for deals and they're like, when do you think I should start looking to raise money? And I was like, yesterday.
Yep.
And what I always tell, I see a lot of investors, they focus on their marketing. They whatever their marketing strategy or strategies are, they spend a lot of time, energy, and effort there. And a lot of times these are wholesalers that are maybe flippers, right? Wanting to fix and flip or wanting to have some rentals, but they have a great marketing strategy for deals, but not for dollars. And so what I tell, investors or students, whatever I'm coaching, is like, if you're a full, really a legitimate real estate entrepreneur, there's two things that you should be doing every single day. And I mean that. You should always be marketing for deals. You should always be marketing for dollars. So it doesn't mean that you have to physically be trading your time for that, but you should be building out YouTube videos, putting things into the marketplace, using your team, doing direct mail, whatever it may be, to look for deals, but also for lenders. And I've met very, very, very few investors who actually had a marketing plan and strategy to raise money, to have lenders available. And then that's why they get a deal under contract. Like, I got a deal. And now they're rushing around either trying to raise money at the last minute and they have no relationship with the lender. That's usually not going to work out. Or they're kind of relegated to go to hard money, and they pay through the eyeballs, which if your numbers work, then it's fine. But a lot of times, like, you're right, they don't even have the cash to get a deal closed with hard money. And if they had focused a little bit of time on some lending relationships or partnerships, they could just really, really take advantage of this market. And that's why I tell people, it sounds like cliche, but like, there's so many win-win opportunities out there, and investors they're not thinking about how they can really help people, meaning lenders, and they're thinking about themselves and their deal. But there's a synergy that could happen with lenders. And I can share a short story, if you don't mind. It really impacted me when I began raising money in 2008. Was I really started seeing, like, so when I started, and I guess I'll tell a little story. When I started in 2007, it was a different world. So I actually was able to get 10 rental properties. I went and bought 10 rentals, got them refinanced with Fannie Mae financing, even though I was broke, living in an apartment. And it was just crazy.
Yeah.
Sometimes people ask me, how'd you do that? I'm like, that's a bad question. Like, in order to do that, yeah. If they invent time machines, I'll teach you how to do it. But otherwise, we're good about it. There's a lot of work involved, but the financing was easy. Well, that ended in 2008 because I couldn't get Fannie Mae loans anymore. And but I still have my goals. I wanted to buy 10 more rentals. So I didn't know anything about private money, but I just knew about partnerships, like basic concept. Hey, you want to partner with me? So I put together a couple small partnerships and with some people who, here's the thing, everybody wants to invest in real estate. Very few will, but everybody wants to. And so what I started seeing is like, hey, I know how to buy these houses now. I know how to find them. I know how to fix them and hire contractors and lease them out. And that was a tremendous value to some of my partners at that time who had corporate jobs or small businesses. So I partnered with them. I went and out, ran the business, bought properties, and we created small LLCs and bought rentals. And that worked great until 2000. And then 2009 came, and I started really thinking to myself, I'm like, all right, that was great, but do I really want to share 50% of my deals? There's nothing wrong with that. I just decided I didn't want to do that because I began learning about private money. So 2009, I'm still using hard money, but I began, I found a lender, had a relationship here, got another lender to invest with me. But when I was talking to private lenders, and I was doing my deals back then. I remember when I was picking up the phone to call them. Didn't really text much back then because that wasn't like a big thing, but calling my lenders, and I was always nervous and I felt like a beggar and a borrower. I was like,
Yep.
man, I hope they say yes, please loan to me. Like, I'm like in this position. And one day I was talking to my first partnership and my second partnership, and she had pulled a bunch of money out of the stock market in 2008 to invest with me to buy these rentals. We bought 4 rentals. She pulled a bunch of money out. And we were talking in the end of late 2009, and we were I forget what we were talking about. It was kind of like an, oh, by the way thing she said at the end of a conversation. And she was like, hey, oh, by the way, I was going to tell you that I was looking at, my financial stuff. And if I had left my money in the stock market, she was like, it would have devastated me. She's like, and she had just retired. She's like, I wouldn't have been retired. I'm so, thankful for, that you came to me with this and that I acted upon it. And everything changed for me right then, because it was no longer of like, hopefully I can get financing. Hopefully I can keep doing deals, till it was like the amount of real estate I can do is limitless, right? All I have to do is find the right people in the partnerships and just add that value to them. And that's easy to do. If you're running a sustainable real estate business, people want to invest in deals. They want to invest with you. They don't necessarily want to do all the stuff that we as investors do, but that's the main thing I would say is, if you are an investor today, spend time on your lending relationships. And they're not just lenders, they're relationships that you need to nurture, invest in, spend time with. And if you do that, then you'll have the keys to the kingdom, right? And that's why I'm happy to say we've never not done a deal because of financing. Like, it's never happened. Like, if we have a deal, we're taking it down, because what I found over and over and over, like the law of private money, if you want to call that, it's attracted to 2 things: it's attracted to good deals and good people, right? People who operate in integrity or trustworthy. If you've got a good deal and you're operating that way, it's like you become I hate to say it, like you're like a money magnet. So you don't have to worry about financing at all.
Yep. Well, it's just also like the unconscious process of how our brains work. If you don't have any money to close on deals, sometimes you naturally stop looking for deals, even though you're working in the day-to-day business. You're doing things, but you're not actually trying to find a deal, because if you do, you can't actually close on it. Where now all of a sudden you have $1 million pop up, just naturally 4 250K rental properties pop up, and it fills the gap of what you just raised. So when you have money sitting there that you can get into play, your mind shifts into a different state where it's going to actually start looking for those deals, and they're going to start popping up left and right. But
100%.
You wrote a book. Hold your book up, Brant. So you wrote a book called what? Private Lender Playbook.
Private Lender
So guys,
Playbook.
if you're looking to, so you can get that on Amazon, I think, still, and or where do they get that?
Yeah, and that was brought about, was not to make money, but when I was talking about having a marketing strategy for your lenders, like, I meant that. And so one of the greatest ways to market is to educate, just leave with value. So I'm not telling everyone to go write a book, but the more that you educate people and you help people, the more people that are going to seek you out, right? So I wrote that book with one purpose, really, was to educate private lenders about how to safeguard themselves, how to analyze deals, how to analyze borrowers, what are closing documents and things like that to expect, and just how to really invest passively and do it in a safe way. Because I see private lending is that's one of my favorite investments. I mean, I started lending as well years ago. I've lost money on the first deal that I loaned on, even knowing as much as I did. So I violated one of my own rules. And so I just put on the book, and, that's what I teach other people to do as well. It's not necessarily write a book. You can if you want, but look at what you're doing, right? With YouTube, Connor, is like, create some case study videos, show people, ways to safeguard themselves, ways to invest passively, things like that, and just teach people about what's out there. Don't try to raise money online. I'm not telling you to do that. There's SEC, and it's a real thing. One of Connor, someone that we both know, is behind bars right now from doing it the wrong way. So you got to be careful of that. Do your own due diligence and figure out how to, do it wisely. But that was my whole thing, and it's worked like a charm to the extent where, and we have a backlog of private lenders. We have a financing company now, so we're loaning money on investor deals, partnering with our lenders. We partner with other investors, like you talked about, who feel like they can't get a deal closed. Well, we partner with a lot of them because we've got a surplus of money, and that's what we're probably better at raising money than we are finding deals. To be quite honest, we're pretty good at finding deals, so we are able to leverage our lender relationships, but it's synergy. It's win-win. Our lenders love us because they want to invest in real estate passively. They know that we've got a perfect track record, knock on wood, and that we're going to take care of their investments and do it the right way. So there's so much opportunity out there. People just kind of, they have that limited mindset, or they're focused on one deal or whatever it may be. So
what's kind of the conversations you're having with some of your long-term lenders? What's kind of their mindset? So obviously you have the investor mindset, which is, fearful of not getting deals, running their business and everything we always used to dealing with. But on the backside, we need to work with the lenders. And when you work with them closely, you're working with lots of millions of dollars here, emotions rise, relationships build, and can get stressed on and off. What's kind of as this market's kind of turned a little bit, has you had different conversations with these lenders? Are they still pro getting money in the marketplace, or they're kind of backing off a little bit, pinching a little bit down, and let's just go a little bit slower? Kind of what's the sentiment out there behind the scene in the lender world,
no,
in the private lending world, not the institutional world?
Yeah. So it's usually it's converse to the stock market a lot of times. So if the stock market's crashing, there's more security that we have with real estate. So that's why, and I talk about it in the book. It's Wall Street versus Main Street. It's like, okay, you got $100,000, you can put it, right here, right down the street, 123 Main Street. You can invest in this brick, 3-bedroom, 2-bath house, costs whatever. There's $50,000 worth of equity. There's this feel good story with real estate that, hey, here's your options. You can send that 100, 200, 500 grand, whatever you have, to Wall Street, where who knows what is going to be done with that money, where it's going, how it's being used, how it's being managed, and could it like literally evaporate like before you wake up, which could theoretically happen, right? Versus, we've got a home that we're buying right down the street. This is a story kind of tell them, we're buying, there's at least 25% equity above whatever your investment is. We close at a title company. There's title insurance. There's property insurance. We've got a survey. We're providing renovations to it, which means we're hiring local contractors, buying materials from local companies, revitalizing or investing in your local community, taking this property from ugly to beautiful. That's going to be, a home for a hardworking family in our neighborhood that you can drive by, touch, and feel. And God forbid anything happens to me, you can take it back and probably make more money. It's an easy sell versus who knows what your money's doing over there. So that's usually a pretty easy sell. And it's not a sell. It's laying it out. This is what we offer. This is what Wall Street offers. It's really easy. Now, one of the things that I strongly encourage people to do or not to do is the only thing that we have to do, Connor, is with our lenders in today's market, because it's scarier for some people, is just assure them that, like I said, good deals and good people, but the deals are structured the right way. Hey, we're not pulling money. We're not just pulling money together. Like, I'm getting very concerned with some people that I see who are creating these syndications and real estate funds, and that's scaring me because I don't feel good about people who are potentially going to invest with them. Like, literally, I got a message the other day from a guy I know, and I really like him, but it's above his head. And he told me he was going to create a fund. He wanted to let me know. I was like, that's cool. What type of fund are you creating? He's like, I don't know. What are you talking about?
And give me some money.
Yeah, it
Let me pull
scares me.
Millie, bro.
We don't pull money. We have a rule: one lender, one lien. So while some of these funds could say, hey, wire this money today, and it could be sitting there, and you're earning or accruing interest. But if the money they're borrowing is not making money, there are Ponzi schemes that exist, and there's a lot of stuff that happens. So we're real still conservative, right? I take sometimes phone calls from lenders who are complaining that we're not putting their money to work fast enough. Like I get that call,
Yep.
and I'm like, I'm happy to get that call because we're not just going to go take down deals unless it meets our criteria. We're going to safeguard you. So I'd rather you wait another month or two and we get you on a deal that meets our criteria. And then, and the other thing that we talk about too with lenders is sometimes lenders will, they're weighing, hey, here's what it looks like if I invest with you versus over here. And, I usually talk to people about one of the greatest books ever written, the story of the tortoise and the hare. And I tell them,
I've been talking about that multiple times recently. I've been
yeah,
using that for multiple reasons recently.
yeah. It's like, hey, the tortoise versus the hare. We all know how that story plays out. And so, like, let's say, for example, you invest with us and we put your money to work on a property, like we're buying a mobile home park right now, right? And like, I can put your money there, pay you 8% paid monthly each and every month until we either sell it or when we refinance it, and we'll refinance it at some point in time. But right now, it doesn't make sense. So I'm like, you could look at that 8% each and every month versus maybe you could get 12 over here or 15%. But what if your money's sitting for 3 to 6 months a year? Or what if you have to take a deal back, right? And you unfortunately lose money or don't make any money on a deal. I've seen that happen a lot. So we kind of pitch to, like, we're looking for the people who know how the book ends and are happy with that. So that's kind of how we navigate through things.
Well, what do you think on? So I think also like talking about all these funds and syndications popping up. It's kind of similar to what we were talking about earlier. It's this Cardone, all these YouTube generation. It's the backseat driver that's sitting on the couch. It used to be, oh, I could see HGTV. Oh, I can flip a house. Now it's like they see these big deals being done. They see the big numbers. They're like, if I can just do one that's going to change my life, and then they get caught up in this. And I've been hit up by like 7 or 8 different ones that people just close
Yeah.
proximity to me are now creating. It's really quite crazy. What's your take on all that? Like why we're starting to see more of these big syndications and deals? And then I want to go into like a couple ways that would be the best ways to find some of your first private lenders, and then some of the catching points that you may have, that like the objections or pushbacks and some of the main blocking points that stops you from getting lenders. But let's kind of touch on this new push of all these big funds and syndications, which they can't all operate at the same time, and it's like everybody's fighting for the same money across the same pool of
Yeah.
relationships and things like that.
Yeah. I mean, I love the fund model and the syndication model. We've syndicated a few deals on our land deals. And to me, that's a beautiful thing because land doesn't cash flow. So we're able to safeguard our risks. But, telling our lenders coming up, hey, this is a long 5 to 10 year play. We're basically parking money. We bought the land really, really cheap and waiting till interest rates go down, development takes off, and then we'll be great. So there's places where syndications and funds work great. And so I get it. Like I totally get it. So I'm not telling people don't create a syndication, don't create a fund. But a lot of the funds and syndications that I've looked at, there's a lot of them out there. I don't know what percentage it is, but they don't look like they have a financially sustainable business model. I don't even understand the math on some. Like, this doesn't really make sense. But everybody's got a greed gland, and what
Yep.
you see a lot of what I call irrational exuberance. Like, everyone's excited because they see people making money and there's all this opportunity, but the like legit business owners or people who've been in the game a long time, you can kind of differentiate from your newbies. and less experienced people, because they're focused on the upside, right? Like, man, if we raise this much money and do these deals, like they see the upside. But your OGs who've been in the game 20, 30, 40, 50 years, who've like really like built companies and done all this stuff in real estate, they look at that, but they spend more time looking at the downside and what are the risks and what are the bad things that happen, right? And then it goes back to like what Sam Zell said, which one, I say this all the time. We're looking for low risk, high reward. And the problem with the fund model that I see is people are like, maybe moderate reward, equal risk, maybe even higher risk, lower reward. We see that in multifamily, right? And I'm like, I don't want to play that game. I want low risk, high reward, or I'll just say no and I'll back out. But it's out there, man, and you're starting to see it already with some of these. I've seen multiple multifamily deals going under, banks taking them back, interest rates are adjusting, all that kind of stuff. Because most likely, whenever that lead investor or investors took down that deal, they didn't take the time to really ask those questions, or they kind of just pushed them aside. They didn't really want to look at that. They had the greed gland getting all excited and just looked at the upside. And so that's the problem with the fund model, is they're not taking into account what could be happening here pretty soon in the market.
Yep. It's very common. That's how like, people are like, how does somebody make a bunch of money on like flipping 10 houses and then they lose on one? It's because they get that they're forward thinking. They're only seeing what can go right, how maximization, if every comp gets hit, you can maybe just skill it. Like they're not thinking what goes wrong. And then also if they've never done these things before, they don't know, how many times a house can go on. I've had houses go under contract and off like 4 times. Now, when you think about that, that's increasing the carrying costs. That just washed out the profit, and then you have to go do extra things. So these are things y'all need to be careful on your business, running your numbers, leaving some reserves around. Don't get so aggressive as we have over the past few years, because I had a bad spot in 2018 where I had like 6 or 7 flips going on, and I had huge, probably $500,000 in profit in all of them, but I couldn't get to it because I got too leveraged out, and I had to slow them all down to finish one, get it sold, pull the equity in, finish 2 more, pull that back in, and then I lost probably another 6 figures or more just in extra carrying costs and expenses because I got tied in. I didn't have a back end lender that could come in and who would be willing to lend in that second position. Now I do this with IRA money. Is a very common way if I get stuck, where if I need to bring in a little bit extra on the back end for a smaller amount. But let's kind of talk about some of these lending options, and let's first go into like what would you start to do if there's an investor right now that's struggling to raise money, that's getting deal flow but needs the money. What would you do if they're like a wholesaler? Where would you start? What would be some of the first things you do, or where would you start to try to develop these relationships with their first private lenders?
Yeah. So concentric circles. So start with close friend and family. And so a lot of people say, well, you shouldn't raise money from friends or family.
Yep.
And I would say, well, okay, that's your choice. I say you don't invest or do business with friends or family if you don't trust them, or if you're not okay or comfortable losing that relationship if something happens. But also, let's say, like, if you can't trust friends or family, who can you trust? So you need to start with your friends and family and your very close network, even if it just means having conversations to get comfortable having conversations. Because a lot of people, they're not natural born salespeople, and these conversations can be very difficult for some, especially if they don't have a sales background. So for me, I started talking to friends and family, and what I really realized. So I started with my close circle, and what I really realized, like, it was all practice. It was training for me when I expanded my circle and talked to people outside of my initial sphere of influence was like this big in the beginning. So then I started meeting people from networking events, going to real estate seminars, stuff like that, going to IRA events, obviously. And then, like, my wife was a hairstylist, and she had a client, and he was a business owner. He's like very wealthy, very successful. So by the time I got to talk to him, I had already had like 20, 30, 40 other conversations. So I had got to work on my quote unquote pitch a little bit, sound a little more polished, a little bit professional, be able to handle objections. So that's what I recommend, is like, you just got to start having conversations. And what you're really doing when you have marketing conversations, you're marketing, right? So look at Look at McDonald's, look at Coca-Cola. What do they do every single day? They're advertising, advertising, advertising. So when you're having conversations, you're marketing who it is, what do you do? Basically showing them an opportunity that exists in the marketplace, because a lot of private lenders, especially newbies, they don't even know that private lending is a thing. And that's where you can find lenders from your neighbors down the street, which I've done, sitting talking to Johnny's dad, who's at the football game, that your kids are on the same team. Those people invest with me. People at your church, wherever. I always say lenders are hiding in plain sight, but if you're not marketing to them or having conversations, they're never going to know. So that's where you start. When you get real comfortable with your pitch, or if you're really doing some deals and stuff like that, then you can start creating some video content, do some email marketing. But once again, when we do, it's really important is that we don't, in any of our marketing, we never say, hey, invest with us, promise, promote anything. We educate people. We let them know that, hey, this is a case study. Here's an example of, a loan that, a flip that we did utilizing a private lender. So people know what you do, they're going to begin reaching out. And so what you do is you just want to show proof. And I would say that too, like the greatest form of marketing is showing proof, right? That you can provide a predictable result or outcome. So the more that you do that, people are going to trust you more and more and more. And that's why I do case studies and stuff like that. Is like, I just want to show people proof that we know what we're doing, and that, we can have a conversation and see if they would trust us or not.
Yep. Just credibility marketing. So like when I got in, very similar, I was using two things: raising small amounts of money for my dad, like $10,000 at a time, to get into like mobile homes on land. And then I was using credit cards to fund the materials, went to renovate the property to get it up. And then I was using cash advances to pay my contractors sometimes. So I was using a combination of small loans for my family and credit cards, how I acquired my first few properties. And then later I started getting my first lenders going to the networking events. And I think that's probably the best place to go. Even Brant and I got connected through a Quest event. They're now Quest Trust Company, but they used to be Quest IRA. That's actually where we got connected. That led to another business that has generated quite a bit of income. But when you're getting in conversations with them now, this is the second thing. So now you know where to find them, but now when you start trying to get in that conversation, where are some of like the locking points that people struggle with? For one, obviously approach anxiety, meaning they don't talk to anybody. They know they need to, but they don't do it. But then like, what are some of the questions? Where do you kind of feel private lenders kind of back off, where they feel like this is risky, or I don't understand, or where you think some of these young investors struggle to raise money?
Yeah. I mean, I know all this is really, it's sales. Okay. So a lot of people come into being an entrepreneur or real estate, and they don't have any sales background or sales experience. And you need some type of sales training and approach with people. And what that means to me, what that means to me is I typically don't talk a whole lot about myself or my business. The conversations are typically focused on them. What do they know about private mortgage lending? Is there anything they don't understand? What are their fears and concerns? I want to touch on that right away. What are their goals? I like to figure out their risk threshold, and things like that. So I try to just ask open-ended questions, try to figure out if it's a good fit for us. Honestly, I'm like, hey, is this person a good fit for us? But also want to know, is it a good fit for them? Because we've had some lenders with a very low risk threshold. Like we've literally had some lenders who invest with us, and like a week or two later, they're calling, hey, is everything okay? What's going on?
Right.
And then like, we kind of like, are you nervous? Everything okay? Because we've done this a few hundred times, this is kind of the process. And then I've had to tell some lenders, this may not be good for you, because there is risk here. So I would say if you lead with value, you seek first to help, right? And you seek to understand and make sure it's a good fit. And so that's what I mean by sales approach. Like I like to kind of pull back from investors and try to scare them. Honestly, I try to scare them a lot of times. I'll do it jokingly a lot of times. I'll make comments. I'm like, hey, what if I'm the next Bernie Madoff? I'll throw out stuff like that. And I'm like, the cool thing is, if I'm a shyster, if you read this book and do what you should know how to do, you can safeguard yourself. And I'll tell them that. And I do actually consultations with lenders in other states and other marketplaces who read my book, they fill out a form. I'll give them a quick coaching call, and I'm like, do this, do this, do this, and you can safeguard yourself. So if
Yep.
you're a investor looking to raise money, make sure you can really help that person. Like, focus on if you can help them. If, for example, if I have a lender who's got, they've got a goal to earn 30% return on their investment, and I'm like, well, that's a usury infraction there, but that's not a good fit for us. We're looking for people who are typically happy at 7 to 10%, and they just want hands off. So, if someone's looking for 15, 20, 25%, it's not good for it. Fit for us could be a fit for someone else. And what I tell people too is like, I try to be really, really honest with people, like, all the time. And when it comes to, like, people ask me all the time, like, what do you pay for your money? And I say, as least amount as possible. And lenders will call and like, hey, what are you guys paying, on your loans? I'm like, it depends. What rate of return would you be happy with? Because if someone's happy at 5 or 6%, we're happy. That's what we call a win-win. We're going to move forward. If someone's happy at 15%, we're not happy. We're not going to do the deal. And I always tell lenders, like, really transparently, I'm like, my goal, my fiduciary responsibility with my family, my company, my employees, is my job is to raise money and obtain capital at the lowest rate that I can get, right? And terms and stuff like that. Your job is to get the highest rate of return that you can get safely, right? And I'm like, the question is, do we find a happy medium? If so, we'll do a deal. If not, that's okay. So if you just are transparent with people, educate them, help them, and make sure, damn it, that you can provide the results that you're talking about, that you're promoting and promising, then do that. And make sure that that you perform on your word. That's like, I've lost sleep. I've had sleepless nights because my back's been in a corner, but I'm like, no matter what, I'm going to perform with my lenders. Like, I'm going to find a way. When I've had times in the beginning where it was a little bit dicey, right? With business and starting things out and cash flow. But if you go on with that intention to perform, to honor your word, take care of your lenders, then that's like the way the law of attraction is going to start really coming to effect. More people are going to find you. You're going to get a good name. We just had one of our lenders refer us another lender last 2 or 3 weeks ago. Has got like $750,000 to invest. So we're like, steadily deploying our money. Yeah. So that's just the way it works.
So we're coming to the end here. I want to touch a little bit on owner financing, but it is important. You said something a little bit ago where I think it's always a one-sided perspective where investors are just like, I got to get raised private money, but they're not thinking of the risk of also who the lender is. They're, the lender's obviously thinking this investor could be risky, but you mentioned that, you could take someone's last 100K basically, and they're going to be hovering over you and stressing you out left and right. But the other risk is that you need to be confident that these lenders are going to close. Whereas let's say you only have one lender and you got a house under contract and they're saying, yeah, I'm going to close. What if they don't follow through and you get left at the closing table? So that's something that you need to take in consideration also, to have an idea if they're, spreading their money out around to other investors, and kind of like, you just need to not get caught. So raise multiple lenders so you don't get caught in that spot. But one of the ways you can raise money is directly from the seller. And this is actually how I got my my rental portfolio started. I was wholesaling and flipping, but I wasn't bank financeable yet because I was still in debt. And this is when I started making offers direct to the seller with owner financing. And I actually started buying houses, some of them where I didn't even have interest payments on it. They were just 100% amortized. But you've been doing a lot of owner financing. I know you sell a lot on it, but are you buying houses direct to the seller? And then with the tightening of institutional lending, interest rates where they're at, what's your take on buying houses right now direct to the seller with owner financing?
Yeah, I love owner financing. It's my favorite strategy with real estate, right? Yep. Like if I had to pick one from now till forever, it would be selling on owner financing. We don't buy a whole lot with seller financing. Don't do a lot of sub twos. Have done a few. The sub two deals that I see being done by other investors scare the crap out of me.
Me too, for sure.
Because I had an investor call me this week, and she's in Colorado, and she was telling me about, hey, I want to see if you partner with me on a deal. Well, tell me about your deal. And so they're buying 50 houses from a developer who went under or something like that. There's some story going on with it. And she laid out the numbers, and I'm like, you're going to have negative cash flow about $1,000 a month per house. And she's like, well, yeah, that's the strategy. But at 5 or 10 years from now, we're going to sell, for the, we'll cash out the equity. I'm like, run. And she's like, well, it doesn't. Our houses, she's like, well, you don't understand real estate in this state. Real estate doesn't cash flow. I'm like, find another state. So the sub two deals I see, which is essentially seller financing, a lot of those don't work. I know some do. I'm just like, it's not something that we target. We make offers on it, but a lot of times there's not enough equity in the deals because they just did a refinance or bought the property, 2, 3, 4 years ago. Or there's some investor who's going to pay more than us. So we don't do a lot of them. We ask a lot of the time. My acquisitions agent does ask that question if it's open. So we don't buy a whole lot, to be honest, on seller financing. We have in some commercial deals, and that's very common there.
Yeah.
It's very common there. And we're actually, now that I've turned around several of my parks, we're getting ready to sell those, but we're really specifically looking for seller finance investors who are looking for financing, because I want to essentially control the real estate, and I don't want to give up my cash flow. I just don't necessarily want to have my team managing the parks anymore that are stabilized, sell them at full market value, and sell on owner financing. That's my favorite strategy. I can't remember if you asked me something about it, but I think it's the thing is, the more tools that you have in your tool belt, it just makes you a more sustainable investor, because everything's cyclical in the marketplace. And there's certain tools or strategies that will work today that won't work tomorrow, or won't work as good. And if you can have those tools in your tool belt, you don't want to be a jack of all trades and go out and learn all the 10 things at one time, because you can't do that. What I teach people to do is focus on one strategy, get to know it really, really well. Boom, you've got it. It's in your DNA. Boom, then move on to the next thing. That's why I had bought 25 rentals before I flipped a house. And so I'm like, okay, I got this down. I'm ready to go to this. And I started doing that. And I'm like, okay, owner financing, got that. Okay, now we're lending. Okay, it was almost 10 years later. Okay, boom, we bought RV park, mobile home park. So it took time to build out that wheel of experience and tools in your tool belt. But when you do that, when you do different deals and you learn, you go to boot camps, like you learn, now you're more sustainable when the marketplace changes. But what you have to do, this is the thing that I see people not do, is they don't shift when the market's telling them to shift. Airbnb investors, that has also been another thing that's really scared me. When I look at some of the numbers, I'm like, I don't care if it cash flows 10,000 a month, you have no equity. And if that strategy goes away, this is not a deal. You're losing money.
Yep.
So that may be starting to change. So the thing is like, you can have these tools in your tool belt, but you have to know when to use them. And to quote Kenny Rogers, I'm going to date myself because a lot of people don't know what Kenny Rogers is, but know when to hold them and know when to fold them, know when to walk away and know when to run. And
to me. I mean, I agree with all that. Last quick questions on the way out here. Biggest benefit that you see in owner financing, why, like your main reason why you do it, and then like one of the biggest risks that you could run into. And I know you kind of had one crazy one not too long ago where
I had a couple during COVID. And it was fun, but
so one upside and one downside, and then we'll let you give wherever you want to send people, and we'll get all your links and everything below here. But I do think that you guys, if you do not learn the skill set of owner financing and understanding, this part of the business, especially in certain markets over other types of markets, you're going to really struggle long term. And it's just something that you have to integrate into your business model.
Yeah. The So I love owner financing. Partly, I think it's because I'm older, but I'll explain that. Like, if could draw out here, there's three buckets of business or real estate. There's your active bucket, what you do to fill up your active income each and every month. Your passive bucket, like passive income, things that you can do to leverage property, teams, systems, other uh, systems and things to create income. And then there's your wealth bucket, like creating true wealth. And so a lot of people will, and this is how I started, was I was taught and told that rental property was passive income, and that passive income bucket, I could fill it up quickly and easily, and it would fill up my active bucket. Meaning I could just buy a bunch of rental properties and fill up my active income bucket and my passive income bucket, which would spill over into my wealth bucket. Maybe I did things wrong, but it didn't work for me. Okay. Because I had 25 properties. I'm like, this is not passive at all. A lot of the income I put back into the business. Okay. It feeds the beast. Now I was creating wealth and I was really happy with that. But at a certain point in time, I'm like, I want to do something that I actually enjoy to fill up my active income bucket, make it a lot more predictable, make it a lot more fun, like that I actually enjoy. And that's when I started flipping houses. The first house, well, I lost money on the first house I flipped. Long story. But the second house I flipped, in 60 days, I made $65,000, which was more than I worked an entire year working at my corporate job before that. So I was like, one deal, 1 year working a corporate job, sold, I'm quitting my job. So that for me, and essentially still to this day, is I flip houses as my main, like that's my job, because I enjoy it, and I've built out a full team to flip houses, right? And flip 3 to 5 houses a month. So that's my active income bucket. Now I've got the passive income bucket. Rental property, I don't care if you have a property manager. I hired my first full-time hire 13 years ago to manage my property. I'm still cutting the checks. I'm still dealing with the overflow of headaches. I have dealt with a couple of lawsuits that we've always won. And it's not a fun business model. I have not met, let me think about this. I haven't met too many rental property owners who aren't stressed out at some point in time, right? And so what I started seeing was, like, as I got older, right, there's some benefits to have rentals, as we know, tax benefits, appreciation, all that kind of stuff. Those are great. Like, you should have rentals. I'm not saying don't. I still have rentals, but it's a much smaller percentage of my portfolio. And I stumbled upon owner financing because we were doing a make ready. One of my rentals had to do like 3 or 4 make readies one month. And I had close to 50 rentals. And 3 or 4 make readies in a month is not fun. Like, even one, it's just like sometimes they're depressing. People tear up property and stuff. So I'm sitting there with my painting crew, and I'm probably saying some expletives and complaining about something or whatever. And they came up like, man, this is a great house. I wish I could buy it. And I'm like, you can buy it. I'll sell it to you. And we just figured it out. I got a real estate attorney. I owner financed that property to them over 10 years ago. Well, yeah, 9-10 years ago. They're still there. They haven't refinanced. So for me, Connor, it was like, I'm getting older. I really want true passive investments that are very predictable, just like clockwork, right? There's still a lot of equity in each of our notes, which help to create my wealth right on my balance sheet. And it's a much more passive investment. And then I found out, like, too, like, if you truly enjoy working with the people that you work with, right? Like your clients, like, truly feel like you're helping and serving them, versus if you don't really care for your clientele, like, just waking up in the morning is not so fun. There's nothing against people who are renters, but for the most part, my demographic are homeowners, people who,
Yep.
They have a good job, they've saved up money, they're putting a down payment, they're putting skin in the game, they're wanting home ownership, they're wanting that American dream. That's who I want to work with. That's for me. Renters, not so much. So that's what drew it to me. It was very predictable. It was more the people that I wanted to work with. I think you asked me about the risks, the upside. The The guy who I owner
Oh,
financed that home for, I sold it to him for like 110,000 at the time. It's worth at least 250 now. So I've given up, that upside, but I look at what I've made in interest, and he doesn't have any plans. He still works for us after 13, 14 years been working for us.
yeah.
So I'm making my money on interest. I'm happy for him. At some point he'll cash out. I'll get the equity that I have in it, and that'll be fine. I don't want to go too much on this, but there's foreclosures, all that kind of stuff. Dude, I don't know what happens if like hyperinflation kicks in. Then probably all my notes will pay off, but then I'll just pay off all my real estate, So
Yeah.
I don't know. Other than that, and doing some foreclosures on occasion, I like it. I get it's not for everybody, but
It's good to have it's good to have them have a little bit of appreciation. If like it makes them more likely probably to want to make the payments because now they're protecting equity. So if it keeps them performing a little better. But yeah, man, thanks for coming on here today. I know I know you're super busy doing big deals everywhere, but where do you want to send people? I know you've got your YouTube channel. It's called Brant Phillips Fundamentals, or what's the name of it?
Brant, they can just go to brantphillips.com is the best place. Brantphillips.com. I failed to mention the greatest form of passive income that I've found truly is EXP revenue share, though. No risk, high reward, but I guess you've covered that in some of your other videos.
Well, we can do a part two. But yeah, so I try to tell people I've been in business now for over a decade. I've tried up to 30 different income streams. Now, obviously, I don't have 30 income streams. I've tried some where it was like a 1 month fling, and I realized I'm not doing this. Different affiliate, like lots of little things. I've been in the insurance space. There's never been anything as far as like residual income scale faster than the revenue share model with the lowest risk. Because I just took a property back that I had to win an $8,000 judgment. You don't have that happen with rev share because you're not dealing with that risk and liability, and you don't have a net negative backwards run through rate, meaning you're not driving marketing expenses and actually can take risk and go backwards. So it's really just your risk of your time and your ego. But I think investors and agents, I think everybody should be doing both sides of business. On this side, flip a house, keep a house. When they come to EXP, sell a house, add an agent. But if you guys want to have that conversation with Brant and I, so Brant does quite a bit for his organization. He's got almost 400 agents here at EXP. He's a multi-time icon agent. And if you're looking to raise money, you'd be in close proximity with someone that's raised a ton of it. But we'll have you back on here. We'll go into some other stuff as the market turns, because I think, it'd be interesting to come back here in a few months as we move into winter and see how this plays out. But yeah, on that, grateful for you coming on here. We'll put up Brant's contact information below. And if you want to reach out to him, guys, just go ahead and find that information down in the description. And other than that, we will see you guys on the next one.